Hi all, Midun back with a new video. In this video, I'm going to cover interview question for regarding guarantee and insurances. So basically, this is the third video of our topic like interview questions for quantity surveys. So in this video, I'm going to cover the potential question related to guarantee and insurances. So we in our previous videos we cover quantity survey interview questions for variation and interim payment certificates actually. So this is the third section which is covering guarantee and insurances. So not wasting much time, jumping into video straight away. So first question will be like types of guarantee bond you are aware of. So interview will be asking what are the type of guarantee or bond you are aware of. So basically in a construction there is, you can see three types or four types of bond actually. Yeah, so which is like I'm adding one more over here which I missed. So basically there will be performance bond or a performance certificate, sorry, performance guarantee, advance payment bond will be there, tender bond will be there, and a retention bond will be there. These are the major four bonds you can see in a construction industry. So performance bond is basically which you submit, which also known as the performance security. So it's you have to submit this performance security during the initial starting of the project. And performance security a key requirement for any project to start actually. So basically you are guaranteeing your performance, so you're going to perform this work. If you're not performed, you have a bond from my end and you can encash this bond in case I am not performed. That's the function of a performance bond. The percentage of performance bond will be agreed between the party. It could be 10% or some other percentage. It depends on what you agree between client and the contractor. Okay, next is advance payment bond. So if you want to get the advance payment from the employer, you have to submit a bond for equivalent amount. Okay, if you're getting 10% of advance payment, what you have to do is like you have to submit a advance payment bond from a bank with the same amount of money. If it's 10% total, if 10% of the contract value is the advance payment amount, you have to submit the same value for the advance payment bond also. The other one is tender bond. So tender bond basically submit during the submission of tender actually. So during submission of tender, the employer will ask, or when you send the RFP, he will ask you to submit tender bond also. The function of tender bond is basically, so if you submit tender and employer okay with the tender and he send you a contract also, but then you telling like no I can't do the work, and if you back off, then employer has to re-tender entire process and he will lose a lot of time also, and now he has to do the re-tendering and he need to pay for that also. So all these will be covered in tender bonds. If you are if you submit the tender and you got the contract, and if you are not working, then they will submit the tender bond and get this money out of it. So that's the function of tender bond. There is something called retention bond. So you know that there is a retention money in all the contracts. So when you submit the payment certificate or payment application, and when the engineer issue payment certificate, they will hold some money as retention. Okay, the purpose of retention money is basically during DLP period, if you're not performing defect notification time, if you're not performing the defects, or if you're not rectifying the defect, that will be captured through retention money. So if you have, that's the function of retention money actually. So sometimes in order to ensure the, what do you call that, in order to get the money in advance, contractor will submit the retention bond and will get the money out of it. So retention bond, if you want to get retention money in early, because usually the retention money will be released after TOC, like 50% of the retention money will be released on TOC and remaining 50% after the completion, like after DLP period. So if you want to get early release, you will submit that bond and get it released. That is a function of retention bond actually. Okay. Moving forward, next question will be difference between bond and guarantee. It's like a classic question you can see whenever you go for an interview. Maybe they will ask you this question. But if you ask me like bond and guarantee provided by a financial institute has equal value actually. Depends on the wording. Depends on what you write in the bond. If and is provided by financial institute, it has equal value. But if the guarantee is issued by a company, because a contractor himself giving a guarantee, that does not have a monetary value. That's only undertaking actually. Okay. So moving forward, next question will be like validity of the bond or guarantees. So performance bond, it has to valid till the end of TOC. Until you get TOC, you need to have performance bond. Okay. And advance payment bond till valid till the recovery of full money. So you got 10% of advance money, and if the full amount of money is recovered already, then you don't need to renew your bond. But if you are not, if the advance payment money is not recovered completely, what you have to do is like you have to maintain the bond. The tender bond validity, basically if you submit tender bond, it should be valid till you submit the performance bond. So till performance bond is submitted, there have to have a valid tender bond actually. And retention bond validity depends, like how much you getting retention money out of it, you have to submit the retention bond, and it should be valid. Like if usually 50 per 10, if you holding 10% of the retention money, the 5% will be released by TOC. So the 5%, 10% will be bond value should be valid till TOC. After TOC, you can reduce to 5% for retention bond. Okay, then there will be like ask you like what are types of bond, or what is like conditional bond or unconditional bond. So basically there's two types of bond which called conditional bond and unconditional bond. If it's a conditional bond, employer has to prove there's a mistake by contractor. In unconditional bond, there is no need to prove the breach actually. So contractor commit a mistake, or they done some mistake, they done some breach of contract, then the employer can straight away go with the unconditional bond, give it to the bank and encash it. But in terms of conditional bond, he has to prove the breach. Okay. So then this is very important question actually. How do you review a bond? So if you got a bond or guarantee in hand, example, you're sitting in with the employer or engineer side, and your contractor submit a bond to you. How do you review? So first you have to review the format. So with every contract, you will be providing a sample to the contractor, and he will tell you initially, I need a bond in this particular format. So first you have to ensure the format is correct. Then the bank, you will also mention that you need a guarantee or a bond from a international or a national bond which is approved by the employer. So you have to check the bank entity which is providing the bond is okay for your employer. And the validity, as per the previous case I explained, you have to have validity in case of PB till TOC, sorry, still perform certificate. In case of advance payment till recovery, like that you have to check the validity also. And you have to check the wording. You have to ensure it's unconditional and revocable bond, because you shouldn't accept a conditional bond and finally fall into issue, like you have to prove the breach and all. To avoid those issues, you have to ensure it's an unconditional bond. And also you have to ensure there is no additional clause by the bank, because sometimes the bank, what they do, they attempt to put some clauses in the end, some kind of clauses and legal steps. So you have to ensure there is no such clauses by bank. It should be completely by the format which you have given. Okay. And then the question will be when you should renew the bond. Okay. So you know that performance bond which has to be valid till DLP period. So till DLP period you have to maintain the bond, and in any case DLP period is extending, 28 days prior you have to renew the bond. Same with the AB, advance payment bond. If the full money is not usually they will submit for some 1 year. Okay. And if it's not recovered by that time, it has to be renewed. Okay. And just to one thing additionally I'm adding over here, when in case of advance payment board, if you recover some 50% of the money already, then you can allow the contractor to reduce the, if contractor requested, you can allow them to reduce the bond value, because that will add some facility or bank facility for the employer. This purely depends on what you agree between the employer and the contractor, or what contract says. Okay. So moving forward, our next section was insurance actually. So basically type of insurance and other question will be covered over here. Okay. So what is the function of insurance? The question will be like, the basically the function of insurance is like, to cover the risk, cover the non-risk. Okay. For example, you're riding a car in a road, and there is a potential chance like it can get into an accident. Maybe you are riding in a perfect way, but somebody else or some other driver can hit you also. So there is a chance like when you drive a car on the road, there's a potential chance like a chance for an accident. So that you're covering through a insurance which you, when if you have a car or a motorcycle, whatever, you take insurance. So same purpose, you know the risk that's been covered through insurance. In a similar way, construction industry also, we know some sort of risks which we already know. Those risks are being covered through insurances. Okay, what I explained is basically the non-risk which we nowadays we taking health insurance also for the elders and us. So we know that there is chances during the year like we may get sick, so those will be covered through insurances. Okay, uh, and there is like mainly non-risk will be covered in the, because we know only, we don't know like what is to be happened, the risk will not be covered. Okay, and the types of insurance and its coverage will be a question will be asking. This questions will be applicable for both RICS and also for the interview purpose. So basically you can see there is insurance like car insurance, contractor all risk insurance, car insurance, a workman compensation insurance, employer liability insurance, planned equipment insurance, work insurance, PAR which is property all risk insurance, motor vehicle insurance, PII which is professional indemnity insurance. These are the major insurance you can see in a contract or a construction contract. Okay, so the car is the contract or contractors all risk insurance is basically taken by, maybe sometimes taken by employer or some by taken by the contractor, actually depends on the insurance model. So insurance model means there will be two types of insurance actually, you know, maybe employer procured insurance will be there, contractor procured insurance will be there. That you have to define in the contract initially who going to procure insurance. Okay, so the insurance model you can see in the contract for initially like insurance will be procured and maintained by the employer, or if contractor will be procuring insurance. So those things will be depends on that. Car will be procured by either by contractor or by employer. If for example if a very big master development like a city development or a functional development places, car will be taken by the employer, because there will be 100 contractors will be there. There will be building contractors, there will be infra contractors, so all will be covering under a single car insurance, because employer will take one car insurance and he will have the provision in the insurance to endorse different contractors. So as contractors step in, they will add into the car policies. And one thing you have to remember, in every cases principal will be the employer. Okay, you have to ensure that principal will be employer. And workman compensation basically as per law, if you are in UAE there will be a law, whoever working under the contract has to have an insurance as per the law, and there will be a minimum coverage for that. Planned equipment means whichever planned equipment you're using in a construction plot limit or a construction project, it has to be insured. So basically the coverage will be full replacement. If that's been broken down, it full has to replaced. Okay, then there is an insurance called work is capital work, WORK in, and W is capital. That means all temporary and permanent work will be covered under this. Usually it is 115 percentage, 100% of the work plus 15 percentage. Why 15 percentage? Like 5% for the redesign, 5% for the supervision, and 5% for the this removal of the debris or whatever you call. So total work 100% plus additional 15 percentage. Then you have property all risk insurance. Usually employer will take this insurance once taken over the work. Once the work is taken over by the employer, they will take the public property all risk insurance. Okay, a motor vehicle insurance actually taken by the employer or contractor, depends on the vehicle they use in the site. It should be full replacement. Okay, so whichever vehicle they using in the site, it should have a proper insurance. If you want to use a vehicle inside site, it has to be properly insured. Okay, usually it will be full replacement. And PII insurance is called provisional indemnity insurance. Okay, for example, if you're doing a work or a professional work, a design work, those things should be covered by a professional indemnity insurance. For example, a structural design consultancy or a piling consultancy, they all have to provide PI insurance, because their work is very critical. Any mistake in their work going to collapse the building. So that all covered through PII insurance. Okay. So how do you review a insurance will be a next question. So firstly, obviously you have to ensure there's a validity as per your requirement. The project is 1 year or 2 year, it has to validity up to that stage. Usually contractor will give you an insurance which is valid till 1 year, and they will be renewing after that. So you have to check what are the exclusions. That's very critical thing. Okay, it shouldn't be the case like you get a insurance and but most of the case clauses are excluded or most of the provisions are excluded. Then there is no use of getting insurance also. Then the next very important point is waiver of subrogation. Waiver of subrogation is basically a legal or a doctrine or what you call that. It's a clause in the insurance. This is giving a right for insurance company to sue the party who caused the damage. It looks complicated, but let me explain a simple way. So you are an employer and there is a contractor, okay, and you take insurance and you pay the premium also, and then during the construction period you advise some additional work. Because of additional work, that project caused some damages. Then, if there is a subrogation clause in the insurance, the insurance party can cause sue employer actually because employer instead some additional work. Because of that work, a damage is incurred. So the insurance party will check who caused the damage. Then that will give a right for him to sue the party. That is called subrogation clause. So you have to ensure that is waived out of the insurance. Subrogation clause shouldn't be in the insurance. Okay. If it's a car insurance or many parties cover, you have to make sure cross liability clause is there, and all the parties should be treated as separate entities in this. Perils you have to verify, laws you have to verify, and one more very important thing, you have to ensure the principal is always employer. Okay, because for example, a damage is caused. Okay, if a water leakage or a water ingress happened in a building, and there will be huge claim submitted by the party. Okay, ultimately employer suffer the loss. Okay, if a employee is not the principal, this money will go to who? Our contractor. And obviously contractor also suffer the loss, not denying it, but he will get the full money in advance. If principal is the employer, as he recover the work, he will pay, employer will pay the money step by step. So for that purpose only we making principal as, sorry, employer as the principal. So there are major questions coming from insurance, sorry, guarantee, bonds, insurance questions. I hope it's clear. If you have further doubts or clarification required, contact me or ping me, or you can message me over here also. You can connect me in LinkedIn. My profile will be like Midhun Suvarnan, MIDHUN SUVARNAN. Thank you guys and all the best.